Eric Muad with Muad.com with the world market analysis for the weekend of September 26th and September 27th, 2015. Take a look at how Asian market closed on Friday. See a mixed bag, about 1.7% up in Japan. China was down 1.6%. Hong Kong was up slightly. Australia was down slightly, and we see that pretty much a mixed bag. Shenzhen was down about 3%. We'll take a look at how the European markets did close on Friday, and we see that pretty much a nice up day in Europe. Let's call it about 2.5 to 3% gain on the major averages. Right now in the Americas, take a look at Brazil, which is what we cover here in the analysis. Brazil down about 1%. Right now, with 1 hour to go, about 45 minutes before the US market closes, we see that US markets are slightly up on the Dow, and we see that the Nasdaq and the S&P 500 are down. The VIX is up about 3%. Crude oil is up about 1.43%. So let's take a look at the charts. Okay, let's take a look here, begin by taking a look at the Canadian market. This week, we are seeing it drop below the previous weekly closing low of 13,437. As long as that's the case, this is a broken chart with the probability of lower prices on the weekly. And as we have been discussing the last couple of weeks and months, the biggest risk continues to be that we are still, despite all the volatility this past week, still trading at 3-year lows on the RSI and also 3-year lows on the MACD, which is a major sell signal. So one should not be surprised if markets eventually trend lower. Let's take a look at the Brazilian market, which is down also today, about 1%. Go back to the previous move. We see it came back here and did show resistance at a declining 50-day moving average. And this type of resistance at a declining 50-day moving average is really some confirmation of bear market behavior, which makes a lot of sense. On the way up, for example, as you can see here, market used the 50-day as support on its way higher. Since then, it's turned around and the 50 has become resistance. Every time it comes around the 50, it's being rejected. We also see that there was a slight attempt to move higher on the daily, which was a trap because it came back to test the previous breakpoint. The breakpoint here in May brought the market off the current recent highs, and so what the market was doing was just testing that level. It came here and it touched that line almost perfectly with uniform activity, which I call uniformity, and since then it's been down. Now the biggest risk here is if you take a look at the Brazilian ETF that trades in the US, the EWZ, the fact that the weekly RSI is trading below 30.90 is a major bearish market behavior and should actually indicate lower prices until it moves back above 30.90. And we also see that as of right now on a monthly chart, we are seeing that the monthly RSI and MACDs are confirming lower lows this month. So 3-year lows on both MACDs on the monthly for the EWZ on the and then also on the RSI, we've moved to fresh 3-year lows. And more bearishly and more importantly is the fact that now we have what looks like another move, or at least a fresh move back to levels below 30.9. As long as that's the case, this market should continue to see lower prices. So if you really want to see how this is going to play out, the best way is to wait for it to move back above 30.9 on the monthly so that you can at least have a chance of a recovery. Otherwise, the more it stays below 30.90, the more you should expect lower prices. Let's take a look at some European markets. We see this week, even though the European markets did close positive on Friday, with about 2.5% to 3%, they still remain below the previous weekly closing lows. So even though they had a bounce on Friday, the level to watch there is 4523.08. Anything below that on a weekly basis, and this goes back to the previous recent weekly closing low, anything below that would suggest still lower prices. And the level on the RSI that we were expecting support now still looks like it could be resistance. Remember, on the way up, this was being used for support level. The market would bounce every time it touched this level. Now, if this market is to recover, it needs to move back above this line. Otherwise, the way it's trading, keep in mind that we are also looking at bearish crossover here between the 13-week moving average, undercutting the 34-week moving average. The setup here is still very bearish. In fact, keep in mind, just like we see across the globe, the biggest reason for markets to go down and the biggest argument, in my opinion, is the fact that we are trading at fresh 3-year lows here on the MACD, also moving below zero for the first time on the MACD, first time in more than 3 years. That's a major sell signal, and we see that right now we are trading at fresh 3-year lows on the RSI, on the monthly. So as long as the monthly charts continue to look this way, it is very hard to find a reason to be bullish in the current market environment. If we take a look at the FTSE after Friday's close, it did manage to recapture the level back above the previous recent weekly closing low. The level to watch there was 6042.92. This happens to be the recent weekly closing high. So keep an eye on that. Anything back below that level would suggest a market in trouble. The fact that it closed back above that level is a little bit encouraging, but then again, it might have another go and probably even break that. And the reason why I say that the break of that weekly recent low is just because the way the MACDs and the RSIs are trading. If we take a look at the hourly chart for the FTSE, you can see after Friday's nice 2.5% gain, all we've done is come back to the level on the hourly where the market has been struggling. You can see even when you extend this way, every time it moves back below the red line, we see the market make a short-term low. We had a break back below the red line there. Market made a short-term high, and also here, uniform activity above the red line and back below it, short-term sell signal. Here was resistance, again, short-term sell signal, and after Friday's move, this looks like still showing some type of resistance on the hourly. So it would not surprise that the markets in Europe begin the next week with a little bit of a pullback because they've come back to the resistance level on the hourly charts. Not to be left behind, take a look at the DAX and the German market, just like the other European markets, and actually even just pretty much every market worldwide. The biggest problem here with this chart is we are still trading with an RSI at 3-year lows. MACDs have already moved below zero, and MACDs are already making 3-year lows. So as long as that's the case, and we are moving to fresh 3-year lows, so that's the key. This requirement that we are moving to fresh 3-year lows, that's a major sell signal. One can still expect this market over time to be grinding to the downside. If we take a look at China over the last week or so, it's been forming a wedge here. So if at some point this wedge is going to resolve, maybe short term for a move higher or short term for a move lower. So that wedge is still developing. We'll have to wait and see which way it decides to go. For now, we also see that on the daily RSI, there's a chance here for it to clear this short-term top side on the daily RSI. So this nicely connects recent RSI highs. If the market wants to recover and at least have a short-term move higher, it needs to clear that line of resistance. Otherwise, anything trading below that would be bearish. And again, for it to move higher, it needs to take out that declining line of resistance. It needs to move above that if it is to see lower prices. So in my opinion, we can also look at the MACDs. If the MACDs both stay below zero, I would expect it to continue struggling. Otherwise, for this to recover, it needs to start trading above zero. Right now, the zero line on the MACD is being used as resistance, just like it was used as resistance here during this highs of August. So you can see here rejection at the zero line on the MACD in August, and in August there was a short-term high. So this was the high in August, and that rejection on the MACD, and of course markets moved lower. So if it needs to recover, it needs to move its MACDs back above zero. If we take a look at Japan, we can see that after this drop on the daily chart, which corresponded with a drop here, this break in the daily RSI, so this drop here and that break was responsible for this move lower. If we extend the same line, you can see that this has now turned into double top resistance over the last week or so, and since then the market is struggling to keep its levels. So this is not good. We can also see that on the daily MACDs. On the daily MACDs we are showing resistance with the rejection exactly at the 0 line, which is another short-term indication of lower prices. A quick look at the weekly, and we can see that on the weekly we broke the recent weekly closing lows after 2 weeks of rest. So that's a major sell signal in itself. Anything below the previous weekly closing low, the level to watch there, if it stays below that level, is 17,792.16. So 17,792. Anything below that would suggest that this market is in trouble. Keep in mind, as of right now, we are looking at a situation where we have this bearish crossover between the 13-week moving average and the 34-week moving average, which by itself is bearish. The last time we had a crossover, it was bullish. As you can see here, we had a nice crossover between the 13-week moving average and the 34-week moving average, which set the market up for a nice move off the lows of middle of last year. Right now we are looking at the exact opposite, which might suggest that net markets are not looking very good in terms of how the Japanese market is positioned. Also, the risk here is that this becomes even worse. As you can see right now on the monthly chart, 3-year monthly chart, on the RSI, we are getting ever close to breaking into fresh 3-year lows. And of course, we know what happens when markets move to fresh 3-year lows. And also we see that the MACD is just now about to crack to 3-year lows, and also has a chance of moving below 0 for the first time in many years. If this takes place, expect this market to be probing lower prices even after the recent move off recent highs. If you take a look at the Indian market, the Nifty, you can see here over the last 2 weeks or so, we are showing resistance at a declining 10-week moving average. Keep in mind that on the way up, this market was using the 10-week moving average for support during the nice rally mode period. Right now we are looking at the exact opposite, which is now the 10-week moving average is becoming more and more as resistance, which is not a good development. It's a sign of a market that eventually wants to go lower at this rate. We also see here that the risk is, and one can set an alert, if it breaks through and below the recent weekly closing low, this market could be in trouble. The level to watch there is 5.05. So 7655.05. Anything below that would suggest a market in trouble. If it can hold above that, that might be good enough to stem the recent sideways action. Because if you take a look at the daily, you can see that the daily is now showing resistance at the recent break level. So there was a break here around the 50. So this break here is what killed that market off the levels here, and we went lower. If we draw a line around the 50, you can see that it's been struggling to hold above the RSI 50 level. We are also trading with a declining 50-day moving average. So even though over the last week or so it's been sideways, generally speaking, the setup is not great. If you take a look at the monthly, the risk, in my opinion, continues to be that the monthly could also crack. And why do I say that? Because other markets have already cracked, and usually markets don't trade in their own vacuum. And so we see here the risk is, again, the problem here is the market could very easily slash through and trade to fresh 3-year lows. And also we can see that the MACD has already traded to fresh 3-year lows and below 0. So if this market is to stabilize, the first order of business is to stop it from making a move to 3-year lows on the monthly RSI. Right now, the risk remains because other markets are already showing that they've already moved to 3-year lows. Also on the Nifty, if you take a look at the hourly, just like we've been seeing in other markets like the FTSE, you draw a line around RSI 61.8, and you'll see that it's been struggling to hold above this level. There was resistance here, which gave us short-term highs. Resistance here eventually gave us those highs, and here recently we went above that level and back below it for those highs. So there's a lot of resistance. This market needs to do a lot of work before it can repair the recent damage. If we take a look at the weekly chart for the Australian market, just like other markets, we are coming back to test the probe and probe the recent weekly closing low there. The level to watch there is 5,006.80. So if it can hold above this recent weekly closing low, that's good. Otherwise, if we crack and break below that, that's not a good sign. Keep in mind, we've been holding to fresh 3-year lows on the RSI and the MACDs, which might explain why, generally speaking, the market still is not looking and acting well. We already moved to fresh 3-year lows on the RSI. MACDs are below zero and making a move to fresh 3-year lows. So the risk continues. As you can see, we are still down for the month. Why? Because the monthly charts are still bearish. One of the leadership markets on the way down is the South African market, and we can see why it's been leadership on the way down, because it was the first market to crack to fresh 3-year lows, in my opinion, about 3 months ago. It's been down since. Also, the MACDs broke down about 3 months ago, and this was one of the markets that led us lower and continues to be looking bearish. In fact, it could actually get worse if the monthly RSI cracks below 50. So the biggest risk here is the Dow. Also, the US markets. You see that the Dow, having been trading, and again, as long as the Dow monthly is trading at 3-year lows on the MACDs and on the RSI, it's tough market to expect to go high. So as long as we are down for the month, MACDs are making 3-year lows and also trading and moving towards zero, this is a market that could easily, very easily, drop significantly much lower. On the Dow daily is a nice way of looking at this market. On the Dow daily, if you can draw a line connecting recent RSI highs, so a line like this one here shows you that until such a time when the Dow can move above that line, one should expect the market to struggle. So for now, I would expect the market to be struggling and probably even pointing lower. We also see that it is only until down the road that the market can clear this line of resistance that maybe there's a reason to think the market goes higher. In my opinion, for now, the risk remains that markets are still pointing lower. Eric Mwathe, Mwathe.com. As always, good luck, peace, and blessings. Woo! I see.